Hey, hi. Okay, so today just wanted to share with you a bit about what can actually save the market. In the sense that Fed, the Federal Reserve's policy, the fiscal policy, right? Whether increasing interest rates um, will um, help to reduce inflation, or at the same time, increasing interest rates will also hurt many corporates, especially in US where they have been so used to zero interest rates borrowings. Of course, with currently interest rates at around 1.5 to 1.75%, and plus there are just realistically many more rate hikes in the months to come. It will definitely hamper capital expenditure expansion by US manufacturing or energy producers, or even will hurt the balance sheets or P&L of companies that are they have loans and finances, and it may even create Chapter 11 bankruptcy proceedings in some companies, like it has already happened yeah, for companies like Revlon, who is into skincare and all that. So, which is a lesser evil, to tame inflation or to force a recession? And of course, increasing interest rates not only will affect the US corporates in terms of their quarterly profits and all that, it will also hurt consumer. As you can see, US company stocks are 70% driven by consumer spending, and this will definitely reduce the consumer spending powers. And I think in my earlier video, I mentioned before that the savings rates data in the US has actually dropped to a low level for the last reports reading. I think it was April 2022 reports. And that probably also shows that there are some consumers who are making ends meet, also are leveraging on credits. That's why you can see that the rate hikes that happened last Wednesday of 0.75%, by actually that would actually help banks, in terms of increasing their profit margins, because they are earning more interest from every lending that they give out, whether it is secure or unsecured lendings. But if credit risks are there for defaults, then of course bank stocks will not perform well in response to the increase in the interest rates hikes. So you also have, of course, another part, which is the Fed monetary tightening that they need to do in terms of their balance sheet, basically to shred off all the excess US dollar they have printed out during the COVID period, and I think they are doing a 50 to 75 billion buybacks per month, and they need to probably get aggressive on that to actually keep their the dollar circulation in the market a little bit lesser and lesser, and to actually, I think their number one priority as well, or equally important priority as well, which is to keep the US dollar strong. Will not happen like in Japan and other NATO countries, like in Europe as well, whereby pounds and euro has actually dropped significantly because of this Ukraine and Russia war. So, um, so which is actually a lesser evil, you know. Allowing, from my point of view, is allowing inflation to have this so-called runaway inflation. Of course, it is definitely bad for the US consumer because there is actually, unless there are wage spiral happening right now, which there are in a way, but it hasn't actually increased that much relative to end of last year to match the inflation increase. So if, let's say, for example, if there are wage spiral increase of like 10% and there's an inflation of 10%, so the net effect on consumer is actually zero. So you know, in that perspective, right, actually consumer spending power is still there, just as much. But of course, with the fear factor out there, they may actually be more conservative in their spending. And but actually that's not really the case right now, even though employment is actually strong. But there has been layoff as well lately, you know, in from Tesla's to Coinbase, you know, those cryptocurrency companies and all that, laying off around 10% to 20% of their staff force, especially in the office administrative section. So this is something that to take note. So I feel that to, you know, and there's also this possibility of US having to increase taxes on their corporations to show that they are collecting revenue to feed their massive borrowings, you know, i.e. issuance of bonds and all that, their repayment capabilities on their bonds issuance. So that also is another negative factor that is going against corporations and all that in the US. And a strong US dollar also actually means that, you know, if you have Microsoft subscriber in Asia Pacific countries, you know, or you have Google Clouds, you know, you're paying, let's say, 40 ringgit or 40 Sing dollar a month, and then you will translate to a lower amount in US dollar. So which means that corporations like Microsoft and all that earning in US dollars, that you will see their income actually reduced by a certain percentage as well as the dollar increases. So from how I see is a mild recession, a kind of like a reset, is probably a healthier way of looking at things. And I think inflation will happen as well. And provided there is no unemployment, if there are a huge layoff of unemployment happening, of course now there are some happening already, but it's not gone significant as yet. So maybe I would say both will happen at the same time. And the only thing is if the Fed were to increase rates even further, that will create a double down effect, whereby a mild recession may not happen. It will create a serious recession, just for the sake of maintaining a strong US dollars. So yeah, I like to share with you another topic later in another video about the concept of stagflation, which is a very dangerous concept for the US economy and also the world, whereby there's low growth and high inflation, which is looking more and more likely right now. So yeah, I hope you like the video and like the content, and share with you my thoughts as we go along. And please like and subscribe. Thank you very much.